So hello and welcome to everybody who's joined so far. We're just going to wait a couple of minutes for people to register and join us as the participant numbers are still going up pretty steadily. So just give us a minute and we'll get started shortly. Okay, I think we'll make a start now. So hello everyone, and thank you very much for joining this, the second in our series of Nest Insight webinars. For those of you who don't know me, I'm Jo Phillips. I'm Director of Research and Innovation at Nest Insight, and I'll be moderating the discussion today. I'm responsible for our primary research programme, including both our work on hybrid emergency and retirement savings in our sidecar savings trial, and also our work on supporting saving amongst self-employed people. In a minute, I'll introduce our event and our excellent speakers, but first a couple of quick housekeeping things. So like everyone, we continue to learn how to run these events and work best with the technology that we have. I'm sure everyone here has been at events like this in recent weeks when someone's connection has dropped. So please do bear with us if there are any glitches. We hope that won't happen today. I also need to send apologies from Will Sandbrook, our Executive Director, who should have been here to chair the discussion today. Unfortunately, he's had to drop out at the last minute because of a family emergency. So I apologise that means you're going to hear a little more of my voice than was planned, as I am both chairing and presenting. We will be showing slides during the discussion. If your screen currently shows a number of equally sized boxes, if you click on the one with the slides in it, it will make them bigger in your screen and easier to see. We really do want these sessions to be interactive, and we're saving good time after the presentations for questions and discussion. There is a Q&A box that you should be able to see. Please do submit questions or discussion points throughout the session, and we'll get to as many of them as possible in the discussion after our speakers have presented. As ever, the earlier you submit your question, the more likely we are to be able to read it and put it to the speakers. So don't hold back to the end. Please do ask as questions come to you. And if you are on Twitter, please do tweet about the event using the hashtag #NestInsightOnline. Okay, so our topic today is about how to help people rebuild financially during and after the COVID-19 crisis. We know that the crisis has put an enormous strain on many people's finances, and the path to recovery may be long and difficult. But we also know that it's vital to help people rebuild their financial resilience, and maybe even this is one of the opportunities to build it back better, to get to a point where more people are in a stronger financial position than they were before the crisis hit. So to discuss what we can learn from behavioural science as we think about this challenge, I'm thrilled to be joined by an excellent panel. In the order in which they'll speak, Dr. Heather Kappes is an assistant professor of marketing in the School of Management at the London School of Economics. Her research explores what influences people in pursuing their goals, including in the field of money management. Wendy de la Rosa is co-founder of the Common Sense Lab, a research organisation which is focused on improving the financial lives of low and moderate income individuals. With Dan Ariely, she previously established the Behavioural Economics Group at Google. So thank you both so much for being with us and sharing your expertise today. We're really looking forward to hearing from you. I'm going to kick us off by framing some of the context and the challenges in a bit more detail, including some of the areas that we at Nest Insight have been working on as part of our research programme. Can I have the next slide, please, Gwen? So the first thing to note as we go into a discussion where we're going to think about solutions for enhancing financial security is that many people did not go into this crisis with high levels of financial resilience. We know that before the crisis, around half of the UK adult population fell into groups described by the Money and Pension Service as struggling, including with high levels of indebtedness, or squeezed, meaning that they're at high risk, they're on the edge of struggling. And of these groups, almost half had less than £500 in savings, and a quarter had less than £100 in accessible savings. And unfortunately, we know that in many cases, the absence of a savings buffer can lead to problem debt. Debt advice charity Step Change was contacted by a new client every 49 seconds last year. So any conversation about rebuilding financial resilience post-crisis, we believe should take into account that for many, this is not about rebuilding, actually. It's about how to unlock new ways for people to overcome barriers that were there pre-COVID, as well as addressing the current challenges. And if we don't think differently than we did before the crisis, we're probably not going to get to different outcomes for people in terms of financial well-being. Can I have the next slide, please, Gwen? It's also becoming increasingly clear that the impacts of the crisis have been very unevenly distributed. And this is something we focused on in our webinar last week, where Professor Elaine Kempson shared learnings from the Standard Life Foundation tracker research. So in the left-hand pie chart here, we can see that in April, just over a third of households were financially secure, whereas just over 1 in 10 were in serious financial difficulty, and a further 17% were struggling to ends meet. Of those households who said they were in serious financial difficulty, just over 2/3 said they had no savings to draw on, and just under 2/3, 64%, had used credit already to make ends meet in the last 4 weeks. There are clearly a number of reasons for this unevenness, but one is that while there have been significant government income protection measures in the UK, not everyone has been covered by those safety nets. So in the right-hand pie chart, the May Standard Life Foundation survey showed that while 6 in 10 households had not seen any impact at all on earnings, and a further 15% were protected by income support schemes and had not seen a drop in income at all, so likely because their employer was covering the remainder of their salary. There were a further 16% who had been only partially protected by the safety nets, and just over 1 in 10 were unprotected by any of the income support schemes at all. So COVID-19 has been a massive disruption for everyone, clearly, but the challenges and opportunities for financial wellbeing are different for these different groups of people. And as we go through this discussion, it's really important, I think, to bear the different contexts in mind. Next slide, please, Gwen. Many of us working in financial wellbeing in the UK and beyond are observing that there are a number of contextual factors coming together that create a new window of opportunity to improve financial wellbeing for some people. This is a really unique point in time for us to reflect and to think about change, for a number of reasons. So firstly, consumption has been down, particularly because of lockdown and restrictions. So what is different about this recession is that some people are saving by default because their usual lifestyle has not been possible. They're not traveling as much, or they're not eating out as much. Many things have just been not possible in terms of the spending that people would have usually been doing. There are also early signs that people's savings orientation may have increased. So financial shocks and income uncertainty are more salient to people now, and having a savings buffer may feel more relevant and urgent to people. There may just be a mindset shift. And all of this has happened at a time when, as we've just seen, the majority of households' income has been unaffected or protected. And some of those who were negatively impacted may be starting to see their income coming back. So one question we're hoping to explore today and beyond is what we can learn about how spending and savings mindsets are evolving, and what opportunities that creates for doing things differently at a time when some households, and I stress some households, may have the combination of changed spending habits, more money available, and be more focused on the idea of saving. And as part of that question, given Nest Insight's focus on longer term financial security, what does this mean for retirement saving and retirement saving mindsets? Next slide, please, Gwen. But we've also seen in previous recessions that the savings ratio goes up only to go back down again soon after. So this chart on the left here shows analysis of the savings ratio going up following the 2007-2008 financial crisis as confidence fell, and then dropping steadily back down again from 2010 onwards. Unless we address some of the behavioural barriers that get in the way of saving, the opportunity to embed new behaviours that build financial resilience, financial wellbeing, may be short-lived. So the second question we're hoping to explore today is what we can learn from behavioural research to help us do things differently this time in a way that supports people to start saving, and once they've started saving, to keep saving in the right way for them. On the right of this slide, there's just one example of a savings app called Plum trying to do just this. So this was an email last week asking its customers to commit to a savings plan before the context changes too much as shopping, pubs and hairdressers start to open. Can I have the next slide, please, Gwen? And as we develop this conversation, we really must not forget those households for whom saving feels a really long way off, if not impossible. We're starting to understand the inequalities of the impacts of COVID, not just on health, but also on personal and household finances. And some of that is compounding inequalities that were already there. We know that the lowest paid, we know that youngest adults, people of colour, women and self-employed people have been worst hit. As one example of that, we can see in this chart shared by Laura Gardner of the Resolution Foundation in last week's webinar that families living on the lowest incomes are most likely to have taken on the highest cost forms of debt. So as we go into this discussion and look ahead, how can we think about how to help people not just start saving who are ready to save, but how to help people move from debt to stability to saving, however long that road may be? And how can we work to ensure that our thinking on solutions reduces inequalities rather than reinforcing them coming out of this crisis? Next slide, please, Gwen. So one thing that we at Nest Insight have been thinking about is how to make sure that any intervention is timely. How can we better understand the moments when people are more or less likely to act? And one example of this is identifying moments when people have unexpected windfalls or found unexpected money. And one example of that is money management app Money Hub, shown on the right-hand side here. Who are doing this with their smart nudges based on understanding people's spending patterns from machine learning from within the app. Another example of this is thinking about whether people are more likely to move from debt into saving if they pre-commit to a debt payment, becoming a savings contribution in future when the debt is paid off. So building in a debt to saving pathway in advance. Next slide, please, Gwen. Another area we are thinking about is incentives for saving, and at a time when people are feeling anxious and insecure, it could be important to think about financial incentives for saving, as in the UK government's Help to Save scheme targeted at people living on low incomes, or this could mean reinforcing the employer contributions and tax relief that are added on top of an individual's pension contributions under auto enrolment. Or others have tried incentives such as entries into prize draws when savings contributions are made. The bottom right of the slide here is the Walmart Prize Link savings card in the US. Next slide, please, Gwen. At Nest Insight, another solution we have been exploring is hybrid savings tools that help people bring together short and longer term goals, rather than those goals always being in tension with each other for the limited financial and mental bandwidth resources that we have. The salary finance JARS savings tool that we're currently trialling in a number of UK workplaces allows people to sign up to build up emergency savings regularly through payroll before the money hits their pocket, and also to pre-commit that once they reach a savings target they've set, their regular savings will then be made as additional contributions to their pension on top of the contributions they're already making under auto enrolment. We hope that access to this savings tool will help individuals improve both shorter term financial resilience and also longer term financial security through the same mechanism. And as we go further through the trial, we're sort of increasingly thinking about whether there are other hybrids, other ways to bring together different goals for people under one mechanism to just reduce the number of things that people have to think about and sort of have to make a decision about any kind of leftover pound there is. Next slide, please, Gwen. So finally, knowing that committing to saving to a regular monthly pound amount is challenging for many people, including those living on variable and uncertain incomes, we've been exploring the idea of more flexible auto saving, which would allow people to save what they can, when they can, flexing to different levels of income. In our programme of work, looking at ways to help self-employed people overcome barriers to retirement saving, we've heard from self-employed people that being able to set and forget savings as a percentage of payments, either via payment apps like PayPal or invoices received via accountancy software platforms, would be really welcome to many people. So now, having set out some of the challenges, some of the questions we have, some of the ideas that we're thinking about, I'm really delighted to hand over to our experts to learn from their research. And I know that both of them have done really relevant research in some of the areas that we've just talked about. And to start to talk about what that could mean as we look ahead from our current context. So I'm going to turn to Heather first. Thank you, Heather.
Thanks so much. So if we can go to the first slide. Behavioral science, kind of the topic of the day, is a discipline that combines psychology and behavioral economics and other disciplines. But what they have in common is trying to come up with answers to questions like how do people make decisions about spending and saving money? And behavioral scientists tend to focus on individual people rather than on big groups or whole societies. But when this process works well, it can let us use knowledge that we already have to make predictions about what the spending of individuals is going to look like in response to social conditions that we see now or that we expect to see in the near future. But of course, in unprecedented situations like a global pandemic, we have to think carefully about how well the answers that we have from past research are going to apply in this specific situation. Now, sometimes there's a big gap between the conditions where a behavioral scientist has derived past answers and the conditions that we want to apply our findings to. And sometimes this can be a problem. So some of you might be aware of this debate around early lockdown decisions in the UK and this question of behavioral fatigue. And when there's conflicting evidence, or when the evidence comes from situations that are really different from the situation we want to apply it to, it can be a less useful base for policy or for designing interventions. So keeping that in mind, coming back to why we're here today, behavioral scientists can use a lot of different methods to study financial behavior. And sometimes it's done with field trials, like some of the ones that Nest is doing, that Jo's talked about, and some of the research that Wendy's going to cover in a bit. But we can also complement that with insights from other methods. And I thought that's what I would talk a little bit about today with a project I did last year that has some findings that I think may be relevant right now. So if we can go to the next slide, you see a picture of the Science Museum in London. That's where this study was done. We were using a dedicated area, the one that you see here with the pink wall, that's called Live Science, where museum visitors can take part in ongoing research. And we started from a behavioral economics task that would usually be used in a lab study in really controlled conditions. It's pretty boring, it would take a long time. And we started from that and made a really short, engaging, gamified version. And you see one screen of it here in the bottom image. And this game was played by about 2,200 museum visitors over a 6-week period. And they were as young as 6 and as old as 80. Now, within this game, what it represents is spending versus saving over 1 year. So participants are playing the game for 12 rounds, and each round represents a month, so altogether a year. And each month they either get some income in a set amount or they get no income. And then they decide how much they want to spend that month, and whatever they don't spend is saved so that they can spend it in a future month. And they earn points for spending money, but the points they earn have diminishing returns. So sorry, this is a little technical, but basically you earn a higher score when you do a better job of smoothing out your consumption, meaning that you're spending at a consistent level. And to do that, our players have to spend not so much in 1 month that you don't have anything saved up for a month where they get no income. So you can see in the section of the game screen that I've labeled A, how participants see how many points they get each time, and then there's a running tally of their points in section D. And the reason why we use this game, which is really different from real world spending in a lot of ways, is to try to get a feeling for how some things that do vary in the real world might affect people's decisions about this very basic division between how much am I going to spend and how much am I going to set aside for later. And you see one example of one of the kind of things that we tested in the section that's labeled E there. So some participants actually have that section blank, they see nothing. And then others see what you see here, which is a leaderboard that shows how your score compares to 7 other players in each round. And then if we can go to the next slide, you see in the part of the figure that's labeled A, that those participants who saw a leaderboard, so it's the 2nd, 3rd, and 4th black bars, anybody who saw any kind of scoreboard did a little bit worse at the game on average. That's in terms of earning a lower portion of the maximum possible score that they could have earned. They did worse on average than people who only saw their own score and didn't see how it compared to anybody else. And this is in line with previous findings from psychology and behavioral economics. It's this basic idea that's sometimes called the pressure to keep up with the Joneses, showing that there's times when we're comparing ourselves, and especially if we're comparing ourselves to others who are doing really well, can lead us to make decisions that hurt us in the long run. And what we can do with this game is to try to see how big is that effect compared to other levers that a policymaker might push or pull. And that lets us gather some of the information that would help with making a cost-benefit analysis when you're considering, well, what am I going to do and how effective do I expect it to be? Now, one of the findings that's potentially relevant to our current pandemic conditions is in section B of this figure. And here we compare participants who started out with a really small endowment before the first round, so they had just a small amount of money in the game before they started getting any income, to participants that we gave a big starting endowment to. And those people who started out with a small endowment earned fewer points on average than people who started out with a big endowment. And some of what's driving this might be psychological. So in general, people that have very low incomes or really limited resources tend to be really, really good at budgeting, at comparing prices, at doing whatever they need to do to make the most of their scarce resources. But the pressure to do that and the attention that it takes up can also mean that they don't have as much attention to give to longer term problems like saving for retirement or to unrelated issues. So attention gets eaten up by figuring out how to deal with the lack of immediate money. On the other hand, this negative effect that we see of this initial scarcity from the small endowment might also just be that people have less cushion for making mistakes. So it's really not clear in this game, how much should I spend? It depends on how long it's going to take until I get income. And when you've got a big endowment, like having a big pot of money in savings, it's this buffer that lets you get away with mistakes that would be much more costly for someone who didn't have those spare resources. So as economies are starting to reopen, a lot of people are going to be like these small endowment players. They're kind of embarking on a new cycle of earnings without much, if any, buffer. And so I think it's interesting to look at what we can say about why these players earned lower scores in the game. And on average, actually, it's that they were too cautious. So they spent too little in a lot of the rounds later in the game. And it seems like having experienced that time of scarcity made some players too careful. And so they lost out on some of the points that they could have had. These points represent in the real world some of the happiness that can be gained by spending instead of depriving yourself. We can come back to the interpretation of that in a bit. I'll just say that finally, in the part of the figure that's labeled C, we compared how well players did under 3 different conditions for getting income. And they managed to make their spending the smoothest, meaning they got the most points, when their income came on a schedule that they were able to predict. So it was clear, like every second round, I'm going to get more money. People did the worst when they got a lot of income at the beginning rounds of the game and then not much in the final rounds. So in this case, they often didn't save enough because they quite sensibly expected to earn more later on. And that case really reminds me of people who get laid off mid-career or whose skills become obsolete. And they earned well at the beginning, but they didn't save enough because they weren't expecting things to go as badly as they did. Now, with this difference between predictable and unpredictable income, it's important to keep in mind that there are a growing number of people who are self-employed or freelance workers or have 0 hours contracts that mean that their earnings can vary a lot from one pay period to the next and can be hard to predict. I know that Nest has some initiatives that are designed around supporting these kinds of workers. And the self-employed, as Jo said, are among the hardest hit by income reductions that we've seen with COVID-19. But here we see that even when the economy is not shut down, that unpredictability in income itself makes it harder to make the most of your money. So these are the findings from the game. And coming back to what I said earlier about how well we can apply findings from specific studies to general policy decisions, it's worth thinking about, you know, things that we didn't test here, like debt, and people who were not included in the sample. So I think that we can come back to these kinds of points in the Q&A in a bit. On the next slide, if we can go there now. This is my last slide. I've just noted a few examples of ways that behavioral science can play a role right now. So for instance, individuals who want to change their habits because their finances have tightened or because they have more disposable income, like maybe some plumbsters, or maybe just because their day-to-day lives look very different. Those people can draw on findings from behavioral science about what are the best ways to effectively change habits. And again, I'm happy to say more about any of this in the Q&A. This note towards the bottom in the orange box is a note to myself, as well as to those who are listening and who are in the position of doing or commissioning new research right now. So one thing I think is important is to make sure that we're doing our new research in a way that's going to produce a reliable evidence base to inform future emergencies. So this is a situation that in a lot of ways is not like things that we've encountered before, but that includes thinking carefully about the methods we use and the groups of people we work with as research participants. And I'll leave it to Wendy to possibly say more on that point. That's it for me. Yeah.
Perfect. Well, thank you, Heather. I think everybody should be energized given that robust academic research. I'll sort of shift a little bit and share what are some of the studies that we've done in the field and how we've been able to change people's financial well-being using principles from behavioral science. So if we go to the next slide, just very quickly, we'll sort of breeze through this, but can you go to the next slide, Gwen? One more. So Jo highlighted the fact that people, at least in the US, do have higher incomes, right? Whether it's coming from stimulus checks, unemployment benefits being higher than they were before. They've also at the same time have decreased their spending in a forcible way. And what you see on this chart here is that just from March to April, total savings deposits in the US have increased by close to $1 trillion, right? So on average, the American workforce is sort of saving more. And if we go to the next slide, the question is, well then, how do we make this last, right? And I think some of our gut reaction oftentimes tends to be, okay, well, let's just teach people how to save. Let's educate them on how to make better savings decisions. So if you go to the next slide, this is a study that I just absolutely love by Daniel Fernandez and others, basically showing that if you get people in a room and you teach them how to save, financial education programs account for just 0.1% of the variance in behavior change. So not zero, but very close to it, right? Suggesting that it may not be the most effective way. And so if we go to the next slide, I think it's very critical for us to understand that oftentimes and many times increasing information does not lead to behavior change. And this is not just true in the financial domain, right? I'm sure many of us on this call have tried to get healthier or lose a couple of pounds. It's not a shock to many of us, right? What we need to do, we need to fix our eating habits and work out more, and yet we struggle with that because it's hard, right? Because it's about changing behavior. So what we need fundamentally is sort of behavior change. And the way that we like to think about how to create our interventions is through a framework I created along with some others called the 3B framework. And the first B, right, is what is the key behavior that you want to incentivize, right? And if you go to the next slide, we think about a behavior as something that's specific, measurable, and actionable that you want to change. So a behavior is not a feeling, it's not an index, right? I think a lot of times we work with organizations that say, well, I just want to increase financial well-being. Let's bring that down to the hacker specific level. Well, what does that mean to you, right? And so I'll give you an example in the next slide. We worked with a financial management app called Even, and we did a field study, simple 3 conditions, where in the US, right before people received a federal tax refund, we said you might receive a federal tax refund. What percentage of it would you like to save? And people had a slider from 0 to 50%. They set their percentage and it said, great, when you get your refund, we'll put that money away. What we varied was whether or not this recommended, right, this anchor, this default was changed to 20%, 30%, or 40%, right? Now, I want you all to think about what do you expect to happen as we move the slider from 20 to 40%, right? Just like think about that hypothesis, and then I'll sort of share on the next slide what we find. But if we look at just the percentage of savers, right? Changing the anchor from 20% to 40% did absolutely nothing in changing the number of savers. Right? And so like if your key behavior here was to actually increase people from saving to no saving, this intervention wouldn't be useful, right? And that's why it's so critical to think about what is the behavior you want to incentivize. However, if you go to the next slide, conditional on saving, all of a sudden, as you move the anchor from 20 to 40%, the average savings rates meaningfully change, right? For a little bit under 30%, to a little bit under 40%, right? And when you dig into this data, what we see is that it's not everybody who's moving from, to a higher savings rate is just about 1/3 of the population. So for the rest, it doesn't matter what anchor you give them, right? They are going to decide on their own what is their best savings percentage for them. And so we're doing a couple of follow-up studies to understand what is unique about that 1/3 of the population that is much more malleable to savings anchors. And what we're finding is that its financial constraints play a big role, right? And so when you are more financially constrained, you tend to be more malleable on the savings anchor than when you're less financially constrained. Right? So let's go to the next slide and think about the second B of our framework, which is barriers. Thinking about, and we think about barriers as every click, every field, every signature, every step, literally every single step that someone needs to do will meaningfully change behavior. So if you go to the next slide and remain in this like tax time savings example, if you click to the next slide, we worked with a company called Digit, and we sent people text messages right when they received their tax refund, right? In this case, think about when people receive their stimulus check. So it's like, hi, Wendy, you just got a federal tax refund this year. What percentage of it would you like to save? Now, I want you to think about all the barriers we deleted with this condition. People no longer had to log into a financial banking app. They didn't have to remember their username and password, forget their password, reset their password, go into their email account to come back, right? Click a couple of different screens to set their percentage. Like all they had to do here was to answer a question via text message, and then Digit will automatically move the money from their checking to their savings account. Now, in our second condition here, we send people a question before they receive their tax refund. And so this is a very hard question, right? So, hi, Joe, you might get a federal tax refund this year. If you do get one, what percentage of it would you like to save? Now, fundamentally, this is a more difficult question. I have no idea how much money I'm going to get. I may have some estimate, but I'm not sure. There's uncertainty built in, and I'm making a decision about the future. But what we found, if we go to the next slide, is that when we send people that text message right when they receive their tax refund, on average, they wanted to save about 17% of that tax refund. Now, in the US, that's really meaningful because on average, your federal tax refund tends to be $3,000. And when you think about a context where 40% of Americans don't have $400 in their savings accounts, right, this gets you a heck of a way there, right? But when we ask people before they even receive their tax refund, early in their tax season, all of a sudden they save 27% on average. Because in the future, we're perfect. In the future, we're going to lose weight. In the future, we're going to save more. In the future, we're going to call our mothers more, right? In the future, I am my own personal version of Beyonce, right? And so oftentimes we think about that bias as a negative, but it can be really helpful. I think I'm running a little bit short on time, so why don't we skip ahead and think about something that Jo has been talking about earlier, which is the fact that we have built financial solutions for a population that doesn't exist. So the most common way for people to save is to set $50, automatic savings deposits every 25th of the month or the 20th of the month from their checking to their savings. But in the US, only 9.7% of employees get paid on a monthly basis. So what I built in conjunction with with a company called Honeyfly is a new savings product. And if we go to the next slide, Honeyfly is a personal finance management app for couples, right? They want people to save. So when you click what your savings goal is, you can choose your own payments, your own savings scheme. And the most popular savings scheme is this payday savings scheme that we created. So about 70% of people want to save a percentage of their income every time they get paid. Now we have to build some buffers, right? Because we don't want people to overdraft. And so on the next screen, if you choose your payday rule, we say, oh, now go back one slide. You say when when $50 or more or $100 or more, consumers can change that, is deposited into this specific account, I want to save this percentage. And obviously we've defaulted it, but you have to think about fundamentally all of the barriers that we're decreasing now, because oftentimes we think about creating savings habits, But that is the hard way to change savings behavior. The easiest way to save savings behavior is to decrease the barriers to savings and create a set it and forget it scheme where people don't constantly have to battle temptation to make a decision. So if we skip ahead, one more slide. I also want us to think about this matching idea, not just from a savings perspective, but also from an expense perspective, right? A lot of our credit cards and loan products have created a monthly due date based on arbitrary details, right? Just when did you apply for the credit card? When did you open up the loan? But that fundamentally mismatches how your income is coming into your checking account. So the last B that I want to talk about, if we just skip forward one more slide, is the benefits. And we think about long-term benefits as not being a benefit at all, right? Most people are present focused. And so as you think about how do we incentivize people to do something today, I want us to think about what's gonna tell on the carrot. And there's been a lot of hype around incentivizing savings. And so I want to share a study that some of my colleagues did trying to do just that. And so we went to Kappes on the next slide, and we were trying to incentivize people to save. And we had a control condition, right? And on the y-axis, you see the average savings in shillings. And then we just reminded them every week to save. And that simple reminder, as you can see, significantly increased savings over no reminder at all. Now, on the next slide, you see we had a couple of incentive conditions where we gave people a 10% match and a 20% match. Now, what you see from the screen is that the bump in savings, essentially by giving someone a 10% match or a 20% match, i.e. incentivizing savings, it wasn't all that much useful when compared to just a simple reminder. On the next slide, we also did pre-matches, right? And so instead of you doing something and getting the incentive, we gave you the incentive first, right? And we know from behavioral science that helps a little bit, right? It's not like it doesn't matter. But look at the differences between a 20 and a 10% match and a 20% match. I akin this to interest rates. Many times we think that people save based on a higher interest rate on their savings account, and that's not primarily the reason. The last slide that I'll share with you is this. We made a reminder where the reminder was coming from people's children. So, hi, mommy and daddy, this is a reminder for you to save. All of a sudden, when you look at the effectiveness of that simple reminder without any whatsoever, it worked just as well as a 10% pre-match or a 10% post-match. I'll stop here and just kind of go to my final slide to say for anybody on the call thinking about creating these interventions and testing, the most important thing is to test, right? But when you do and you create your intervention, think about this 3B framework. What is the specific behavior we want to incentivize? How can you get rid of as many barriers as possible? And a simple click can be a barrier. And how can you incentivize benefits that are not necessarily long-term benefits or monetary benefits? Thank you.
Thank you very much to both Wendy and Heather for those really thought-provoking presentations, and I think for challenging some of the assumptions that many of us hold and that we need to challenge right now if we are to do things differently. We're going to turn now to our discussion. I'd like to encourage people in the audience, if you haven't done so already, please do send through your questions through the Q&A box on screen. We would really love to be able to share your questions with Heather and Wendy. While people are doing that, I wanted to kick off with a first question really to both of you, which is we've sort of talked today both about the insights and the benefits that behavioural science research can bring, and also about some of the limitations of some of that research. And I know from conversations with you both that you know you do feel strongly there are some limitations, both in terms of generalizability, in ordinary times, but also specifically thinking about the COVID-19 context. And I wondered, can you just tell us a little more about your views on that? And particularly for those of us who are thinking about this, what do we need to do to make sure that we're applying the right lessons in the right way and not falling into some of those pitfalls? Perhaps if I turn to Wendy first.
I think that's a great question, and that's why my primary recommendation for everybody is to test, right, is to experiment. Because a lot of the critical findings, well, many, right, that have sort of built our field hasn't generalized to every population. So I'll give you an example of that. We've been working with Code for America in the state of California to help people apply for pandemic benefits. So in the US, you can apply for this benefit called PEBT, so that if your child went to school and they received free lunch and breakfast there, you can get, because schools are closed, you can now get an equivalent of $365, but people have to apply. And so we send people a number of text messages, right? Just a standard, remember to apply, this is important. But in a couple of conditions, we thought about utilizing the social norm research and say, you know, millions of people are struggling right now. People like you, we all need help, apply. Or there was another one that says, like, look, you may be having a harder time right now, just like millions of people are, apply. And what we find is that messaging actually decreases meaningfully and significantly the likelihood of someone applying. And it's because for a lot of low-income people, their social comparison tends to be downward rather than upwards compared to high-income individuals. And so if you talk about like other people are struggling, for low-income people, they say, well, I don't have it as bad as someone else, because in their sphere of influence, they see, right, more people who have it worse than them more often. Whereas higher income people, they tend to do upward comparisons and say, yeah, I'm really struggling right now. Most people don't. And these are the types of nuances that I think have been overlooked in the past. And so again, the key recommendation I have for everybody is to think about the world no longer looks like high income white males who used to be the ones who went to universities and were the participants for many of these lab studies. The world is much more complex. And so in order for us to understand the complexity, we have to test.
Thank you, Wendy. Heather, do you have anything to add to that?
Well, I agree with what Wendy said. I'll try to add a couple things from my perspective. And one of them is, I think, with what she said, you have to test. I think as behavioral scientists, and especially when you work in an academic setting, you're often interested in finding something new. And we often start from the assumption that if somebody showed an effect, it probably does generalize. And I think that's probably the wrong approach. So we probably should be more skeptical, and if anything, think, well, it probably doesn't generalize, because these boundary conditions often make sense in hindsight, but they sure weren't predictable ahead of time. And I think the social comparison research that Wendy just talked about is a good example. From my own area in marketing, for the last decade or so, there's been a really strong, heavily studied finding that people get more happiness on average from spending money on experiences instead of material goods. So there's been a lot of people that have built whole lines of research around that. And then just last year or the year before, a group of researchers came out and showed, you know what, that's actually the opposite for people with very low incomes. For them, material goods produce more happiness. So maybe the finding that we had was not generalizable about experiences versus material goods. It was about, for a certain group of people, what might bring them more happiness. And again, it makes sense afterwards, but I think we only get there by really pushing it and testing it. And our incentive structures in research are often not set up to just keep asking the same same question to new groups of people, but we probably learn more by doing that more than we have been so far. I guess the other thing I would say about it is looking at research that's being done right now. So a lot of behavioral scientists are very well-meaning and excited by the opportunity we have to kind of add knowledge to what's happening and how we can deal with things around COVID-19. but I think it means that a lot of the initial pieces of research that came out were either overlapping, so people were doing things that other people were doing, maybe asking slightly different questions to the same groups of people over and over, as Wendy said, not necessarily getting to very traditionally underserved and understudied groups of people, but instead asking things that don't come from necessarily a theoretical framework, but just, oh, we have norms, we have defaults, so maybe we can try that or we can try that. But it means that the knowledge we come away with is often very fragmented. It's not necessarily going to tell us anything for next time, because we don't really understand why did this work versus not work, and who is it going to work for versus not work for next time. So even when we feel this rush, like this is a once in a lifetime situation, we really need to do something to contribute. Often a little more time and thought is going to mean that our results are much more useful in the long run.
Thank you both. I'm going to just carry on from the idea of happiness that you started to talk about there, Heather, because we've got a couple of questions that I will attempt to link together that are somewhat to do with well-being and health. So the first question is, how do you marry financial well-being with overall well-being? And the question asks, the reason I ask this is because people are saving as they're not socializing and all of those things that perhaps might not be good for them in the long run. So how do you think about those two things in tandem? And then perhaps aligned to that there's a separate question where someone's interested to understand to what extent the approaches we've talked about today can be applied to health behaviors, because if you're not healthy, you can't earn, and if you can't earn, you can't save. So improving health often needs behavior change that could lead to higher financial resilience. So they're two quite different ideas, but both questions are really about how do we think about financial well-being in the context of broader health and the way that broader health contributes the other way around to our financial well-being. Perhaps Heather, I might start with you, given that that's something that you've sort of looked at and talked about.
Yeah, I think with happiness, it's quite tricky, because on the one hand, it's very hard to be very happy or to have a very satisfying life if you're really struggling to get food to eat and a place to live. So I think there is some extent that financial well-being conditions have to be met in order to expect people to be able to be very happy or to have a good quality of life. But on the other hand, we know from a lot of research on materialism that if you link your happiness really strongly to like material success or material possessions, that tends to be detrimental. So I think it's not a one-to-one thing that financial well-being and happiness go perfectly hand in hand, but certainly at both ends of the spectrum and kind of in different ways, it's important to consider. I guess the interesting thing for me in thinking about health behavior change is that a lot of behavior change there requires people to do things that are kind of simple so they can set up straightforward rules for themselves. And for me, a good example is stop drinking. So if you have a drinking problem or you want to improve your health, you can just say, well, no more alcohol. But even for people that have spending problems, we can't really say, well, no more spending, both because we think that's not going to be good for happiness. So if I never go out with my friends, I never buy a gift for anybody, happiness is going to suffer. And it's just not a realistic way to live in the world. So we need to find more nuanced ways, but that sometimes means that the behavior change is more difficult. And I think Wendy gave some good insights into like simple rules of thumb, like percentages for saving. In those cases, sometimes the insights can be applied very well to health, but in other cases, the behavior that you want to change requires that people engage in something that demands a bit different approach. Yeah.
Yeah, I would just add to that to say, at least like in the US, the link is even stronger, because one of the primary reasons why people fall into bankruptcy is because of medical debt. And so the link between your financial well-being and your health is much more stronger. And so we've been trying to think about what are some different ways in which we can help people get insurance, right? So that they are actually going to get preventative health. But Common Sense is part of the Center for Advanced Hindsight, and we do have an entire lab set up, our health lab, to focus on health behaviors. And I do want to say that they are distinct behaviors, mainly because a lot of the things that Heather talked about, I can't go through life just not eating. right? There's no sort of equivalent, quote unquote, of saving, right? It's much harder to get feedback if you're eating right, right? If I'm saving correctly, I see my savings account increase every day, right? I take an action and I see and I get feedback immediately. I work out, I may not necessarily get that feedback for 3 weeks. And so the health domain, while there are parallels, I do want to ensure that we're thinking about this in a separate, you know, on its own right, because it's not a one-to-one relationship.
Thank you both. That was quite a big question, so thank you for coming at it from the different angles. I have another question here, which is around longevity of interventions. So the question is, what is the longevity of such saving interventions? By making it almost frictionless and easy, can you foster long-term behaviour change, or is it limited to short-term change? So going back to that, how do you get people to start doing something, but also how do you make sure that that behavior continues, or is a persistent change and not just a short-term change? Does either of you want to get first, Wendy?
I can start. I would say one of the biggest pieces of evidence that we have supporting the set and forget it scheme comes from 401k contributions. So typically when people start a job, they set their 401k contributions, and the majority of Americans do not change that contribution for decades, right? And so it's one of these things that if it's not top of mind, it just doesn't get done because we have much more pressing things. And so I think when we talk about savings in a, set it and forget it sort of way, you're likely to see similar patterns. Now, is it gonna be around forever? Can you ensure that 100% of people won't change it? No. But that's why we focus not necessarily on creating savings habits, which, people are people, you're more likely to fail, to have a setback, come back, start again. And these like set it and forget it schemes where it's not top of mind, it's just happening in the foreground. I mean, I know all of us have a subscription that we know we should cancel, but we just haven't gotten around to it, right? Because today is not the day. And I think it's the same thing. Now with something like incentives, and maybe Heather can speak more to this, there is some work showing that we don't really understand the power of short-term incentives on long-term behaviors, right? There's some mixed evidence there, and I'm not sure, Heather, if you want to speak on that.
Yeah, that's such a tricky area. And when you talk about long-term effects, I think a lot of research in psychology, like lab research, is really hampered in talking about that because we often just don't measure things over the long term. I think any kind of intervention that requires somebody to do something repeatedly, so whether it's like exercise or eating right, these things are really hard to sustain, especially if it's something that takes willpower and someone's not able to habitualize it in a way where the environment kind of does it for you and you have to keep every day making an effortful decision. In some ways, that's an area where savings has particular promise because often you can do just like one decision change. So whether it's at the point of time of setting up your 401k contribution or setting up something in your savings app, then you don't have to do the behavior repeatedly. And then friction actually works to sustain instead of cancel out the effects. But these kind of spillover effects that Wendy talked about where, maybe somebody does something in the short term. So you start to pay your kids to do their homework and they're doing their homework more than they were. But then after a while you say, okay, enough of that, I'm not going to pay you anymore. There's quite a few studies that find that, okay, now they start doing it even less than they were before. And then some other research that suggests, no, that doesn't happen. Actually, you don't kind of crowd out the internal motivation. And I think it's a question where we don't have a really good framework yet for saying when do we find these effects and when do we not. But certainly it's something we can't hope to answer without doing more research that looks at much longer term outcomes.
I'm going to try and squeeze in one last question now that we're talking about the longer term, which is really to ask where retirement saving fits in all of this, and whether, we've talked about an opportunity for some people potentially to start saving or continue saving from this crisis. But does the opportunity here extend to pension contributions, or is it primarily an opportunity for people to focus on nearer term goals, do you think?
So I think and I'm going to make a generalization, right? Because pre-COVID, the financial well-being of Americans was so precarious. Like the focus, I think, has to be on emergency savings, mainly because we're at the precipice of the cliff, right? So a lot of unemployment support, a lot of stimulus checks are just not predicted to be sustained or continued past August or September. And so as people's sort of safety net goes away that was protecting their income, they're going to have to tap into sort of emergency savings. I mean, that is sort of going to be the next wave, I think, for the next quarter, at least in the US. And so I think rightly so, the focus should be on emergency savings. However, I think for people who will be protected and have income and not suffer sort of that reduction, the biggest thing that I think, at least in the US context, that we can change is disentangle 401k from your employer. Because this new generation, you're only working for one employer on average 2.5 years. And so then you have to start the process over and over and over again. And there's a lot of leakage that happens from retirement contributions as a result of that. And so for me, I think the biggest thing that we could do from a policy change is essentially untie that so that you have your retirement contribution with you wherever you work. And so that you're only making that retirement contribution decision one time, and we can try to nudge you in the right direction, quote unquote, the best we can. But that we're not starting this process every 2.5 years, which is just really inefficient.
Thank you, Wendy.
Jo, I think that's a really good question because of this sizable segment of people who have more disposable income right now than they did a few months ago. And I don't know any research that's actually tested this, so I can't say for sure, but I suspect that most people who have extra disposable income are not thinking about increasing their retirement savings. So for them, it probably is, or at least so far has been, a lost opportunity. And I think that's partly because our pension saving system is not set up to make it easy for people to make like a one-off contribution, especially if it goes through your employer. It's just not something that you think of doing, like, wow, I have a little extra money in my account, maybe I should pop it over into my pension. And I think, rightfully so, people are concerned, well, if things go bad later, I won't be able to get at it, so I shouldn't probably lock it away, and it's just not convenient to do it that way. So then maybe something that some pension savings organizations have to think about a bit in their messaging and in the way their tools are designed.
Thank you, Heather. So I am now very reluctantly going to have to wrap up this conversation because it's been an absolute pleasure listening to you both and talking with you. Thank you so much for all the insights and experience you have shared today, making the time to be with us. We really do appreciate it. And thank you to everyone in the audience for joining. I really hope you've enjoyed the discussion as much as we have. We'd love your feedback and suggestions, as always. And it would be also great to hear from you if you are interested in collaborating with Nest Insight or indeed supporting any of our existing program. And don't forget, we're back next week for the third of our webinars. Join us at 2 o'clock next Wednesday, the 29th, where we'll be discussing how different retirement systems around the world are responding to the coronavirus crisis. We will have with us Karen Andres of the Aspen Institute and Pablo Antolin of the OECD. We really hope to see you there, but for now, goodbye and thank you for joining us today.